What's happening, Internet? My name is Andrew, better known as Drewicious in some circles, and welcome to my basement. Today, I don't want to call it like I'm launching a new series. That sounds grandiose and inappropriate, but I do want to get started on some content that I wish I would have had when I first started trading. And like, look, it's not like I've been doing this for 30 years or anything like that. But I'm a geek. I do tend to research things fairly heavily, and I thought that this might be helpful for other people who are looking for information and don't want to have to sift through like hundreds of hours of research and videos and all this stuff like that. So I'm going to do my very best to distill down to very usable information in a shorter period of time, some foundational information that I think traders can benefit from, or at least the information that I wish I would have had sort of distilled for me when I first started trading. So I'm talking more than necessary. Let's flip over to the content. We're going to go over just like a broad market overview for this first session. This is going to be a multi-part series, and I want to talk with y'all about the way that the market works, to the best of my understanding, critical skills, indicators, how to read candles, strategies, all that kind of stuff, just to try and get you guys set up with some useful information to get started without blowing your face off, on your first couple of shots. FYI, you'll probably still blow your face off a couple times. I still blow my face off sometimes. So today we're going to go through just an overview of how the market works. I want to talk with you guys about some critical things here to understand before you start using your hard-earned money and just throwing it into the market and hoping that things work out. So that our goal today is just to get you to understand how the market works and some of the critical concepts that can help you be successful in the market. So today we're going to go over buyers and sellers, institutes versus retail. We're going to talk about how the market actually moves back and forth, looking at candles, price and volume, and then different time frames. I know that sounds like a lot. We're going to go through a lot of information here in a very short period of time. And I'm feeling extremely professional today because I put together a slide deck that is new to Drew's Basement because I try sometimes. So let's keep things moving. Oh, I went too far. So buyers and sellers, right? The market, it's exactly what it sounds like. It's a market. And I know that word, like when I heard that before I started trading, it sounds just like a thing that happened somewhere else, the stock market. At the end of the day, it very much is more like a flea market. Frankly, buyers and sellers line up on either side of a table and they haggle over what things are worth. That is what is going on. When you see prices going up and going down, it is people arguing over what a stock is worth. And depending on whether the buyer gets their price or the seller gets their price, that determines whether the market moves up or down. That's what's going on. So the truth is, though, that market trading in some ways is a zero-sum game. In order for one person to win, another person has to lose. Now, there are many, many exceptions for that to be true, right? If I'm going to sell you something that I no longer find value in, but you do, then we can both win. So now there are differences there. When we talk about like options or we talk about futures, right? When contracts are exchanging hands, there are definitely times where one person has to lose in order for another person to win. But there are also times where when a stock is on its trajectory up or down, that somebody can sell a thing at the end of their usable life cycle for that seller and the buyer can still pick it up and run with it. And frankly, that's kind of my favorite version of it. I don't love to think of me, beating somebody else. That's not the way that I prefer to think of it. I prefer to think of it. I think some folks do prefer to think of it that way, but that doesn't work for me. So just bear in mind that there's always another human on the other end of that transaction. When you buy something or sell something, there is absolutely, and I say human, but it could be a script, it could be an algorithm, it could be a heartless institute. We don't actually know who's buying the thing that we're selling or selling us the thing that we're buying. But at the end of the day, we have to agree on a price. And back to what I said earlier, that is the thing that determines whether the price is going up or down. Now, there are a couple of big concepts out there: big money, smart money, dumb money. The big money generally refers to institutes, and we're talking about large institutions, banks, that have an unbelievable, unimaginable amount of money at their disposal in order to take a position, in order to move a market, in order to influence what is going on. Now, smart money is a little bit of a derivative. It's slightly disconnected from the super big money, but smart money is very aware of what is going on. They sometimes have inside information, and they occasionally, they frequently are positioning themselves for moves that they understand is about to happen from big money. And then at the end of the day, there's dumb money. And I'm sorry to tell you guys, if you're watching this video, you are dumb money. I am dumb money. Almost all retail is dumb money. Our goal from this video as traders is not to be part of the dumb money. And there are things there. We're not going to go into it in this particular video, but there are things there, and there's a reason that they call it big money. I'm sorry, that they call it dumb money. It is ultimately because we get manipulated. The vast majority of retail gets manipulated, and I know that that sucks to hear, and I want you all to ascribe. And the fact that you're out seeking information and trying to understand better how the market works indicates that you're on the right path to not just being dumb money. Dumb money just shows up and they look at a thing and they have an emotional reaction and they just throw their cash into the market, and they are almost always going to lose their money. So our goal here is to educate ourselves and to understand how the game works so that we can be on the winning side of trades. Now, as you can see in the pie chart off to the side here, retail, right, that's us, the dumb money. Retail accounts for a very small amount of the movement inside of the market. So what that means for us is that we have no chance of actually moving the market. Our buy or our sell doesn't do anything, right? We're just screaming into the void when we buy something or sell something. So our job is not to believe that the market cares about us. We're infinitesimally small in the grand scheme of the market. So we don't matter. And it's important to remind yourself of that. The market doesn't care about you. The market's trying to eat you alive. Just keep that in mind when you go out. So for me, the mindset that is helpful here is just to try and identify the larger moving objects and to follow them along. That is our job here, to find out where the trends are going and not to believe that we can influence anything. It's just simply to find out where the volume is going and to draft behind it. So, but at the end of the day, just remember that institutes see retail as an opportunity, right? Not like an opportunity to make somebody happy, but an opportunity to take their money. That is why we're dumb money. So institutes absolutely look at us as just walking checkbooks or people wandering around with dollars sticking out of their hand. And for the most part, they're right. Depending on the statistics that you look at, 90%, 95%, 97%, definitely north of 90% of retail traders fail because they don't understand how the market works and they don't get to understand enough in order to manage their risk to reward in order to be successful. So that is what I want to talk about for buyers and sellers. Moving on, market movement. So when we look at a chart, and it doesn't matter if you look at line charts, bar charts, Heikin Ashi charts, monkey bars, it doesn't matter. All of them tell a story. And it is extremely important, and we're going to talk about this just a little bit more here in a second, but it's extremely important to remember that market movement is essentially a tug of war, and sometimes a push and pull between buyers and sellers. The only way that a price goes up is if buyers believe that that a stock is more valuable than other buyers, right? They are chasing the sellers, and the sellers absolutely want the highest amount of money. And when markets go down, it's because sellers want to get out of their position and buyers are pulling back, right? So price goes up when buyers are pushing, and price goes down when buyers are selling. I'm sorry, when sellers are looking to get out of their position. And I know that that seems sort of rudimentary, but it is extremely important to remember that those forces are constantly at odds trying to figure out whether something is worth more or worth less. Like if you think about like a used car or something like that, you know, a used car, and this is, and it's a crazy time right now with, shortages and everything going on in the used car market. The value of a given used car right now is very different from what it was 2, 3, 4 years ago. And so that is because supply and demand, right? When there are more buyers lined up around the block trying to get a thing, well, the price goes up, right? That's how the market sort of corrects itself. And so that is exactly what's going on inside of the stock market, right? It is people moving the line back and forth based on their perception, and the imbalance between those perceptions is what causes prices to go up and down. And the better you understand the psychology, and I know I say that psychology as if it's just humans interacting with each other, like a lot of times the majority of this stuff is, yes, humans or institutes, but also algorithms. But even algorithms are designed by humans. So there's always a bias behind things, and there are ways to exploit that to our advantage. Now, the movement that goes up and down, right? Yes, it's represented in the up and down of the price, but there is a very important thing here that I completely missed when I first started trading, is that the story of the volume is critical in completing the narrative of the price. And we're going to look at that a little bit later on in this video. I also want you guys to be aware, and I could put a tinfoil hat on. Look, it wouldn't really help that much. Tinfoil doesn't block all that many radio waves, but there is misdirection and subterfuge. There is market manipulation. I don't mean to shock anybody. If you got to clutch your pearls for a minute, I'll give you some time. We're over. But the truth is that institutes are looking to cause an emotional reaction in retail. That is why we're the snacks. It's why we're the dumb money, right? They want to cause fear. They want to cause the fear of missing out. They want to cause, anxiety and greed. Like those are all things. And like, look, as mammals, we respond to emotions. We are primarily manipulated through our emotions in our political and personal lives, unfortunately. So it's no different in the stock market. And the more aware you are of your emotional reactions and the fact that you may be getting your buttons pushed by somebody else in order to extract your money, the more you're aware of that, the more prepared you are to make good decisions in the market. And it is also important to think about the narratives that are going on, right? When I talk about the prices going up and the prices going down, there are stories to be told inside of the candles and inside of the price action and the volume action that you can take advantage of as you trade. So we're going to talk real quick about candles, bars, sticks, depending on, how you talk about the market. I've got here on my right-hand side, presumably your right-hand side, just the basic anatomy of a candle, right? And there's a big difference here between the bullish candlestick and the bearish candlestick. At the end of the day, when you look at a candle, there's an open, there's a close, and there's a high, and there's a low. And depending on the direction of the candle, right, if the general price is on the way up, you can see that on a bullish candlestick, right, on a upwards move, the open is at the bottom and the close is the top, right? So it is important to think about that as, hey, we opened down here, we closed up here. That indicates some movement. And those wicks up above and below the open and the close tell a story. And depending on the length of the wick, right, there may be barely any wick, maybe none, or there may be a long wick. That tells a story, regardless of whether it's a bullish or bearish candle. You can look at that as rejection in some regards, right? It basically means that a candle attempted to go somewhere, and then the buyers or the sellers said no. right? So that tells you something about what's going on inside of each candle, and you have to string those together in order to form complete stories. And look, forming those complete stories doesn't always give you exactly the story that you're looking for, but that's kind of our job here. As if you're going to be a price action trader or a technical a technical trader, you're going to be looking for stories inside of those candles, right? So the individual candles themselves tell stories, the series of candles together tell stories. So it's not just that it's a line up or it's a line down, right? There are things that you can see inside of those that help you understand and anticipate what may be coming next. And again, moving that price action or integrating that price action into the volume action that goes along with it can help form a stronger story. Now, the candles, they will show up if you're using standard candles, right? And again, there are many different types of candles. I would absolutely encourage you to play around with the different types of candles to find out which ones help you tell the best story and which ones give you the best edge against the market. But at the end of the day, all of the time frames represent these candles. I'm sorry, the candles represent the time frames, regardless of whether you're on the 1 minute, the 1 second, the 1 hour, the 1 week, the 1 day. All of them have the candles and they all do the same job. Now, the traditional sort of way of thinking about it is that higher time frames are more reliable for patterns. So, a pattern that you see on the daily may be more reliable and generally is more reliable than a pattern that you see on the 1 minute, right? Lots of little things happen on the 1 minute. If you zoom out to the 5 minute, the pattern gets more reliable. If you zoom out to the 1 hour, the patterns get more reliable. If you zoom out to the 1 day or the 1 week, the patterns get more reliable. So, but the good news is once you know how to read a candlestick, whether it's on the way up or the way down, whether there's rejection, whether there's support, once you learn how to do that on any of those time frames, you can take that information and that understanding with you to any other time frame. All right, guys, moving on. I pulled this down. Look, this isn't even close to comprehensive. There's a ton of different patterns here, right? And I would absolutely encourage you to go out and just Google candlestick patterns, right? There are cheat sheets. There's all sorts of different stuff from different sources. I'm pretty sure that I'm not allowed to use this by copyright, but I wanted to put this up here just to indicate that as part of technical analysis, these are some of the building blocks that a technical analysis trader would actually look at, right? We're looking for different patterns that sometimes can give us an indication that things are on the way up, they're on the way down, that we're in a period of consolidation. So get out, take a look at these things, and you don't have to learn them all. Start with a couple, right? Start with the doji, start with the gravestone, or start with, 3 soldiers or 3 crows, right? It doesn't really matter which ones you start with. The important part is that you kind of keep going back, you keep looking at them, you look for new patterns, you look at other traders around you if at all possible and find out which ones they're talking about, because those are people that have been down their own journey and they've started to identify some patterns. The more that you see them, the more that you look at them, the more that you get back in and you do paper trading, the more they'll just sort of show up on the charts in front of you, right? When you start to see a doji reversal, or just, I picking off of this chart here. I don't know. I've never actually looked for a bullish kicker before, but like bearish engulfing is a very common, bullish or bearish engulfing, right? When a candle completely swallows the candle before it. I'm a huge fan of inside and outside candles as well. I've got some other videos on that. But these patterns help construct a story. And as you start to build your edge as a trader, you're going to want to look for patterns that you see that are reliable, that you can play and do lead to you getting more wins than losses, or if you do your proper risk management, enough wins and losses that you're profitable. All right. I wanted to pull up here before we're kind of rounding out the corner here a little bit, but I wanted to go through a couple of actual charts. So I've got here the SPY, which is the ETF on the SPX, so the Standard & Poor 500. This is a daily chart, with the 50 and the 100 simple moving average lined above them. So I want to just kind of look at the anatomy of this chart, right? We've got these lines up here that indicate our moving averages. We're going to talk about those more in another upcoming video here. But right, the moving averages tell us a little bit of a story. They're lagging indicators, but they still help us kind of understand where we're at in space and time. I know I got a lot of colors going on here, and I apologize. They mean things to me, and I can explain them a little bit, right? Some of these white bars are outside candles. Some of the gray bars, well, all the white bars are outside candles. All the gray bars are inside candles. We're not going to get into that today. But in some ways, you can just ignore the colors and just sort of look at the way that the price moves. The way that it interacts when we see, when we come down and we see this, we didn't want to go down any further, we bounce back up. And then we didn't want to go any higher, so we bounce back down, right? Like, this is what we're looking for, is we try to make sense of these charts, right? And the fact that we're looking at a daily candle, a daily chart at the moment, this could very well be a 5-minute chart or a 1-hour chart, right? Like, we don't actually know, but you can see that the structure of those candles is here. And whenever I see these wicks, right? Remember when we talked about this story of a wick? A bottom wick here indicates that somebody, tried to sell off, and buyers stepped up and pushed it back up, right? So these bottom wicks can tell us a story, and you can see that this very long, strong bottom wick here resulted in an up move. And there's no wicks up here, but we still turn down. There's no wick there. So wicks don't necessarily always tell you a thing, and you don't always have to have them before a reversal, but they can be a little bit of information that helps you anticipate whether, a reversal or a move may be coming next. The other thing I want to talk about here is down at the bottom. So this is all the price action up here at the top. Down here at the bottom is the volume. And the volume tells a really important story. And like I said earlier in the video, it was one of the things that I completely ignored for a long time as a trader until I truly started to look at the volume in order to find out what the volume was trying to tell me. And we're going to go into that a little bit later, probably not really even fully in this video, but at the end of the day, when you see a high volume or a volume that is sticking up, above its neighbors, that's trying to tell you something, right? That is money piling into that ticker in order to do something, right? It's either because they want to push it further down or push it further up, or somebody is planting a flag and saying, this is where we stop. I want this to reverse. So look at the volume, because there's a lot of information available from that. Now, I know that this is like, I think, an entire year of daily candles. What we're going to do is we're going to zoom in. We're going to zoom in on a couple times here and kind of look at the difference. So this is just 3 days here. You can see that these stripes are the darker periods here are the trading during the day. You can see that because there's higher volume here. And then these lighter gray periods are aftermarket and pre-market. So, as we look at this on a smaller time frame, and I think right now we're on the 5-minute time frame. The 5-minute time frame, it looks an awful lot like, granted, the shape is different here, but at the end of the day, it still looks very similar to the daily, right? These candles are still telling the same stories, right? And as we look around at them, we still see wicks here telling us about reversals, right? We got some wicks over here and over here. There's a wick up there that, they're kind of signaling this up and down movement. And it is important to remember that the price never goes straight up or straight down, right? It is always going to, right? We might get a huge move, right? Look at this huge move right here. And this is actually just like a day, or I think this was yesterday. We got a huge move up, but we're not going to go up forever. And then we're going to double top here, and then we're going to come back down, and we're going to get a wick here, and then we're going to reverse back up. This was a crazy day that we had yesterday, right? That's a huge amount of volatility inside of one day, right? And this day was mostly a sell-off. This day was, a bunch of chop and then a nice strong move at the end of the day. But ultimately, right, we're just looking at these different time frames, and as you develop as a trader, you're going to want to figure out which time frames you're more interested in. A quick note on time frames: generally, the higher the time frame, but if you're trading on the week or the day, you're probably looking at swing trades. You're taking longer positions. You're looking at big patterns, and you're going to be making trades based on longer time frames. So if you're a day trader, yeah, you want to know what the structure is on the higher time frames, but you're probably looking at like a 5-minute or a 1-minute, right, somewhere in that area, in order to kind of see what's going on inside of the smaller time frames on on any given day. And if I went down to a 1-minute here, you'd see more candles, more volatility, more signals and fake outs, right? So by going with a 5 or 15 is probably the most common for most day traders, right? I know some folks that trade on smaller time frames. In fact, I know a lot that really prefer the 1 minute in order to see what's going on at the volume. But But at the end of the day, you got to find one that helps you tell the story. There's no one right time frame. There's only the one that helps you see clear movement. And so, when you look at a day like this, this 5-minute chart tells me everything I need to know, right? I can see that this is very clearly a strong move up, and there was nothing here to indicate that we were going to do anything other than keep going up. Right. And once we hit this double top here, it just went straight back down. Right. So this time frame, this might have actually been easier to play. In fact, it definitely would have been easier to play on like a 1, 2, 3 minute, because this really it's a rapid movement, and these moving averages here are not doing a lot to help make me feel like I know what's going to happen next. Right. These things are way far away from the moving averages. We'll get into that later. But again, we just looked at the 90 days, or I'm sorry, 12 months actually of day charts. Now we're looking at just a couple of days in the 5 minutes, and we're going to zoom in just to one day. This is that really volatile day that I was talking about before, and it's still on the 5 minute. But I want you to see how much more clear it is, right? As we kind of zoom into this, right? This was what a lot of traders watched throughout the day. Now, granted, these moving averages are quite slow. These are simple moving averages. We're going to go into simple moving averages, exponential moving averages in another video. But as you can see, right, these wicks are still telling us stories, right? And the bodies of the candle, right, the wider the body of the candle, the stronger the move, right? We see periods of consolidation, narrower bodies, bigger bodies, narrower bodies, bigger bodies, narrower bodies, lots of consolidation, broad bodies with a huge move down, huge wick at the bottom, indicating a reversal or pullback. Wicks at the top here, indicating, right, like there are stories to be told all over the place on a chart. And I know I was always annoyed when I first got started. Like, sure, if you show me an entire day's chart, I can totally see what's coming next because it's right there, right? This is a lot harder to do in real time, right? And as this candle here was playing out, like I'm looking at it wondering like, I don't know, maybe we're going to reverse. I don't know. But then we get this doji here and we get a nice move up, right? And with each one of these candles, you don't know what's going to come next. So I know I've talked about this in other videos. I absolutely recommend, using paper trading or my favorite feature on Thinkorswim On Demand to go back and trade a day in history like it is happening in real time, because it will help you develop the skills of recognizing these patterns as they play out. Because sure, this is obvious as day. Oh yeah, huge bullish move. I could have made a ton of money there, and I could have made a ton of money here, and I could have made a ton of money there. Right. But we didn't know what this was going to look like as each one of these candles is getting printed out. So, getting to recognize the little patterns of reversals and continuations is helpful. And a big part of that, like I mentioned earlier, is keeping an eye down here at what's going on with the volume, right? When you see big volume down here, they are trying to tell you something. This big candle right here had a big volume push up, and that is a very bullish move. Right? A little bit of consolidation, a little bit of pullback, but ultimately things kind of continued. So play around with your time frames and, get comfortable with all of the indications that are available on the chart as you get comfortable with whatever it is that you need in order to have your edge. All right, guys, that is the end of part 1. I will be back probably relatively soon. These videos are fairly easy to create, so I'm going to try and probably put together maybe like a 5-part series for this foundational series here. I hope this is helpful. If it was, please click like and subscribe to the channel. Let your friends know about it. Nobody lets their friends know about YouTube. What am I talking about? But either way, I hope you come back, and I hope this is helpful for you. So until I see you all next time, cheers, take care of yourself, and we'll talk more then. Bye.